So let's go through a case study here of an HVAC owner and how he put $370,000 plus in his pocket year one through doing this 469-4 aggregation, combining and really buying real estate and then having his HVAC company run out of there. So set up here, the HVAC business is doing $5 million a year of taxable income, structured as an S corp, 100% owner, no state income taxes, but paying 37% at the federal level. And so what he decided to do was buy some land for $2 million. Really, it's gonna be like a shop and a yard, and then about $2 million of shop construction and yard improvements, paving, fences, etc. So the total investment's $4 million. $2 million is the dirt, $2 million is the actual building. Now that real estate acquisition is going to all be done in a separate LLC. So then what you do is once this thing is built out, you now have this $4 million asset. You now do a cost segregation study, and we're going to put a table up here.
Now, would you put that in an S corp?
You would not put that in an S corp.
Okay, that's what I thought. Just following along.
Put that property in an LLC, you do a cost segregation, and you're going to break that $2 million build into the sub ingredients and look to accelerate some of the bonus depreciation. So here, let's assume that the bonus depreciation amount is $1 million. That can be written off. So now you can take, because we aggregated this business with the rent or with the real estate property that the business is being run out of, you aggregate those together. So that $1 million tax loss, not a cash loss, but a tax loss from depreciation can be used to offset part of your $5 million of business profit.
Yeah. And that comes out to 370 grand.
370 grand. Yep. Because if you go from $5 million of profit to $4 million of profit, it saves you $1 million. $1 million times a 37% marginal tax bracket, $370,000.
That's a good day work right there.
It's a good day of work.
Yeah.
All right. Well, then the last thing I want to talk through about this, and we kind of touched on this already, but how oftentimes another back end play for owning real estate with your operating business is when you sell to lock in the new buyer into a 5 or 10 year lease. And then this is a nice cash flow for you as now a landlord instead of a business operator. But break down, and I know, Jim, you've seen this a lot with a lot of sellers of other businesses. Mm-hmm. What's kind of your experience seeing entrepreneurs do this?
Yeah, well, it's a great way to get some ongoing income after the deal is done. And because you own the building separate, that could be part of the deal or it might not be part of the deal. But looping it in, if it's a necessary part of the business, saying, hey, part of the negotiation, make them sign a 20-year lease. I'm just making this up, but a 20-year lease, set the rent levels and the increases over time. And all of a sudden you have that cash flow coming through to you on that building and you still own the building. Pretty powerful concept.
Pretty powerful is right.